So when you're futures trading, you might have a chart that looks like this, and it's a bunch of nonsense, squiggles, doesn't make any sense. And I'm going to tell you how we can take this crazy chart with all these squiggle boxes and actually develop a framework that you can use to make money. Hypothetically, of course, futures trading has a lot of risk, et cetera, not investment advice, all that good stuff. Don't take my advice. But what I can say is that trading in this account, overnight markets, we had a 63% win rate with a 1.9% win-loss ratio with a really good profit factor. 22 trades with 114 lots. Average trade duration is about 2 minutes. So I'm going to go over just how some of these structures work. I'm hopefully going to keep it a little bit basic, but when I say that, it's very unlikely that it's going to be basic. So maybe you'll be able to glean some basic concepts and then put them together into a bigger framework. Let's get started. And so I left my boxes up from yesterday, and this is a complete and utter mess. So we're actually just going to go ahead and get rid of those and talk about some basic fundamental structures, some major structures on the 3-minute chart that give you a direction of intermediate time frame direction. And then also we're going to talk about overall market context and how we can look at macro trends and macro failures to give us an idea of the direction for the day. We're going to go over one specific setup and then how we can operate around when that setup fails or doesn't work, and then a basic concept of this idea of trading around things that either work or don't fail, or work or fail. So we're just going to start with this basic idea of futures trading and what futures trading really even is. You have to remember that this market is essentially completely made up. Like, what I mean by that is that the value assigned to an individual price point or the dollar amount is based on literally like nothing. It's a derivative of so many different things: financial, interest rates, whether or not people are participating in the market, et cetera, an aggregation of all the different stocks that are trading in the market at any given time. But you have to remember, like, you can't eat a stock. You can't eat a futures contract. It's derivative, like so many different steps are needed to turn that into a cheeseburger that you can actually eat. And so what are we even trading? We are trading market psychology. We are trading people who have put positions on, and liquidity, whether or not they can keep those positions open, whether or not they're forced to sell, whether or not there's anybody on the other side to take that trade. And that's ultimately what drives price. We're not trading anything that's any more real than the psychological constructs of the people who are trading. So what does that mean for us here? This basic concept, and then we'll get into some of the technical structure stuff. Hopefully, if you stick around through the whole video, you'll get an actual setup that is hypothetically profitable. I can't say it's profitable because of liability and stuff, but this concept, when things work versus when things don't work. So we'll just take the second entry short, for example. This is a short level up here. There's selling activity that pushes this market down. There is a second entry short. There are viable reasons to take this. So condition 1 is when you sell here and the market continues to go down. You have a viable entry. It doesn't matter what the entry is. I just picked this second entry short to just talk about this psychological concept. You have a viable entry, and if the entry is working, that is one condition. You might hear my dog snoring in the background. Apologies for that. Condition 1 is when the market is responding correctly to your entry. Condition 2 is when that breaks. So no matter what setup you're using, like if we're trading this as a big spike down and a second entry short here, maybe we have a shorter term time frame reversal here. When this is working, that's one state relative to that setup. And then when this fails, we need a secondary operation protocol to assess and then operate in those environments. If it's too many words, just stick around. This is not a simple concept, but I'm going to try to break it down as simple as I can. Condition 1, what you're doing is working, what is expected is happening. Condition 2, something broke. Okay, that's it. A, it works. B, it doesn't. So in this case, for the second entry short here, everybody who was trying to sell this was temporarily in a good position, and then the market comes up above that, and then, oh no, now they're trapped. And then just for this, this trade exactly, you can then buy the high volume node right there. We've talked about that in the market structure. Little thing sticks out right there, the market comes above it. This is a second entry short, it's failed, you can buy there, and then the market trends up. Same thing here, same idea, same concept. Buy a failed delta band. Okay, there's an entry attempt here, it's working, it fails. How do you trade against that failure? So those are the two ideas of this. Now, what are the actual technical structures that we can use? We need to pair both short and long-term time frames. Long-term, understanding the context, And short term, how do we execute in that? Because we're trading on obscene amounts of margin where we can blow our account up if we make one bad decision. Usually one bad decision leads to many decisions. So if you have the market context of the longer term time frame and you understand what's working, what's not, then intermediate context on a technical side, and then the short term context of how do you operate in that. We use a pretty predictable, repeatable set of structures to do that. I'm going to talk about a couple of those now. And then actually what happened here in the Nasdaq as it's failing, essentially. We have talked about in the market structure playlist low volume nodes, high volume nodes, and second entries. We haven't really gotten into trend identification, but what we can do is we can look on this chart and see where are the low volume nodes in comparison to the second entries, and have those second entries, are they working or are they not working? And this is one of the main structures for intermediate context that I use. And by one of the main structures, I mean probably the best structure. So if you made it this far into the video, you're welcome. Here's some free money. Well, some hypothetical free money. So we're going to take this idea of areas that should hold, and we have two of them that are in place here. So let's say this is a second entry short. This market is trending up. We'll just draw some lines. Clear uptrend. This push here is a second attempt to short this top here. It breaks above that. Therefore, this level should hold. Okay, and you see when the market comes back down to it that there's a buy attempt there. It stalls for a little bit before breaking down. So when that market does not hold on this specific time frame, we can then use another structure, the low volume node, and infer that there's resistance inside of the low volume node above the area that has failed. So I'll give you the algorithm right now. Step one, identify a second entry on a longer term time frame. This is a second entry short that should be support. This is also just a range, you can call it that too. Identify the low of that right there. That is the low of this second entry, and then we can call this maybe the low of that second entry as well. Now, once the market goes, this is support, you can execute in there, that's not the setup I'm talking about. Once the market goes below this, we are now failing this and we can sell. One of the best locations in this, if we take the low volume node structure here and look to see where in this break above this, so this is a second entry short, where did it break? It broke right about there. You can, if we zoom in, see this big giant green candle right here with a gap inside of it. Notice there's no overlap right here. We can get more specific. This is so we're using a longer term time frame, the 3 minute, to get these bigger macro contexts. We can get more specific here to get the actual low volume node, but just for the longer term context, we can say that once this is under this, this is a downtrend and this is now failing. When we come back up here, huge response to that. So this is our area, this is our major resistance in this case. So we have this marked as a major resistance category. That's how we identify that. And then there's operations for whether or not this works. Like you can see that it touched there and then pulled back pretty strongly. And then whether or not it doesn't, and to operate in there, we go to a shorter time frame. So now we're down on a 15-second chart, the same exact area, this box here. And we know that we cannot trade against the 15-second chart, especially when things are not going the right way. So what do? We wait for a break of structure here. If this is the uptrend here, there's congestion up there, we push this around, this has now shifted value, and then you can just simply sell value. So you have identified a break of a second entry. Write that down. You have identified that as a major area. You identify the break of the second entry, you find the low volume node above that. Once the price has gone either above or below the low of the second entry, it is broken, and then the low volume node, again above or below depending on direction, is major support or resistance. The market you then go to a shorter term time frame. This is a 15-second chart. On this shorter term time frame, you wait for a accumulation of a high volume node right here. When the market breaks below that, you simply enter right there. You're welcome. So that is that setup. Well, we have talked about profit taking levels. Where should you take profit? Entirely depends on the reverse of that. I'm not going to look on this one. This is just a random example I picked up. Well, okay, we'll just give you an example. Value down here. Okay, find an area, look at the market structure playlist, put it all together and find what else should have worked. What's a good risk to reward ratio? We could talk about position sizing in a different video. That's not the course of, or the purpose of this video. So that's when it works. We see that there's multiple probes up into that area. And then if we find the same exact thing, here we wait for an accumulation of higher volume. We find that that's right there. The market has gone below it. You can see there is another very clear attempt to sell there. Okay, it worked, kinda. It didn't go very far. So condition 2 is when that breaks. And then when that breaks, you just simply enter there and scalp to the top on the shorter term time frame. Buy here, take off at the top. That's how I was able to get that 1 point whatever and 66% win rate. It's waiting for the break of structure in major areas, and then once those go away, simply buy and sell. Do not hold those for continuation in most circumstances. However, once we go clear above that, right here, we then should, and I haven't looked at this, so it might not work. This is the area here. We then see that the market pushes down into there, and then we're breaking above that. That is trend continuation. It's a failure of this, and we wait until a high volume node is accumulated right there, and we can buy that for continuation to the upside. So, and also notice that it tags right here, and then we have shorter term time frame where there's a reclaim of the value area here. Basically, we just, it's not very basic, is it? Once it is broken above this, that's now in an uptrend. This has failed, so the market's going to continue higher. We need to use short-term entries, buy in the value area, and then take it for continuation. And then once that inverts, you can see that once that inverts here, and then this one inverts, the market is all now broken that. So condition 1 is when these setups are working, you identify the major support and resistance. So right here, working, didn't work. Condition 2 is when you trade against that. And the recognition of those is very critical in real time. And oftentimes when these major structures fail, the market goes a lot further than you would expect it to. Like for example here, 55 up to here, that's 120 points. That's, for anybody who trades futures, it's a lot of points in a short period of time. It goes a lot further than you would expect. And then also in the other direction, when they invert here, this is a critical failure. We talked about critical failures the other day. This should hold. When it doesn't hold, from 632 all the way down to here is 300 something points. Just for people who don't trade futures, let me do the math real quick. 300 points on one contract is $6,000 in like 5 hours. And on 5 contracts, it's $30,000. So in theory, if you would have sold here and cleared once this trend reversed here, you would have made like $20,000. So that might give you an idea of why these are critical to understand these major structural breaks, and why it's critical to have a framework on where the major structural breaks actually are. So I'm going to give you another example of one of these major conditions and show you what happened last night in the overnight market right about here that I was able to trade around. Really quickly, right before I do that, I want to point out something. I talked about major contexts, you know, and whether something has failed in the day previous. We have failures here. This is a very major. So consider how much weight, how much volume, how long term of the time frame any of these individual setups on this fractal market are, and then you can get an idea of how much weight is behind that. This is a second entry here when we have a break of this low, this one here actually. This is also a last attempt to hold that range. We have a break of this low down below here. If we're looking at the exact same structure that I was just talking about, we have a break of this low, a inversion of the second entry short. And also notice that this is a viable setup. Second entry short, there's a trend reversal there. It's major support. Major support breaks. So now this is inverted. And then we look for the low volume node, which you can see very clearly there's a start of the break is right here to here. And then even though this broke structure on the shorter term time frame, it pierced into there, and then that was the high of the day, even against a very aggressive up spike inside of this low volume node, which is, if we mark it here, I think it actually gets pretty exact, almost. Right there. Doesn't quite touch it. But if we're starting at the break here, the break of that pivot high, goes right into it. It shoots up from 620 up here, 400 points, and then stops right there. So that gives you an example of how critical these levels are. And we can have traded with a short-term reversal. I'll show that very briefly. I'm kind of jumping all over the place. Hopefully you're following through the info dump. This is a longer video. It's all good info though. Okay, so I got sidetracked on the thing I was going to talk about earlier, but I just want to use this as another example. If this was major resistance, which it is, we wait for a accumulation of a higher volume node right there. It inverts, you sell right there, and you take it down to the value area down here. So from there to there would have been 300 points on that entry. As we know from the math I just talked about earlier, if you would have sold that on 5 contracts, that's $30,000 with this setup right here. Hypothetically, there's a risk. You could also lose $30,000 if you do it wrong. But if you set your stop right here, risk reward's good. So that's on the major reversals. You don't need to understand what's a major reversal and then where the minor reversals are. So in this, we have the same sort of pattern. And this, we'll call this the downtrend, if I can find the right line. Downtrend, K, we'll just draw it there. Market is trending down here. This is a second entry long right here. Yeah. Market's pushing down, attempt to hold this bottom, that fails. Okay, second entry long. You can also see very clearly that these second entry longs are viable setups. We're not talking about those right now, but you should be taking these as viable setups, hypothetically, not investment advice. And then so on that, if we go back here and look, where's the high of that? We can call it here maybe. We can call it here maybe. My refrigerator just kicked on. I'm gonna go turn that off. What's that prank call? If your refrigerator's running, you should turn it off where it splits your brain in half because of the humming sound. Is that the prank call? Anyways, market moved above this. So that's a break of that. Where would we be looking to enter here? Low volume node. Okay, low volume node right there. So wait, it didn't work. What? Exactly. That's condition 2 right here. There's multiple low volume nodes. We're going to go to a shorter term time frame. This is the second entry. I'm going to get rid of this line so it's a little bit less confusing. If this doesn't make sense, keep watching. The more you look at this, the easier these squiggles are to interpret. So this is the second entry right here, where I drew these lines. The second entry long, that's the high of that. Once we break above the highs of those, I'll move that right there, the low volume push below that is an invalid area and therefore should be support. It didn't work here. So we're gonna go look at the chart. Also in this case, why didn't it work? We're in a very major downtrend, and then we have the same sort of thing here where this should have held and it didn't. So it's actually bouncing off of that. So you need to be aware of where, you know, as we go through in your market preparation, mark all of these areas because you don't want to be buying up into here, even though this was a break on this time frame. It didn't work. Why? Because it's in conflict with other setups. We're just going to talk about this right now. Okay, so this should have worked, and you see a big attempt there. When it doesn't work, we're in a failure state. This is another area here. So as the market continues below this green box, we are in a downtrend. Once we're in a downtrend here for another reason too that I'm not going to confuse everybody with. But once this is going down here, we look for where are the accumulations of higher volume. And we have one here, you can sell there maybe, you could sell here. Or as it immediately breaks below this, the aggressive entry, once you've identified condition 2, this is failing, trade in the direction of the failure after this clears, and it even made 2 subsequent lows, which adds a little bit of juice to it. Selling here is viable to take to the bottom. Selling inside this green box is viable to take to the bottom. Where should you take it? Well, there's a major structural low here. You could have taken it down to there. And then even here, once the market retraces back up to it, selling here is a viable trade. I wouldn't have necessarily taken this without the break of structure because we're bouncing off the bottom here. So this is now a structural uptrend. This is also a structural uptrend. This is a clear downtrend. So this is a failure. You can jump on these failures right here. Once these structures, the one I've defined, I kind of slowed down a little bit when I was talking. Hopefully you wrote it down. Once this breaks, you can enter right here. It is in a downtrend. There's no 15-second uptrend. This is in a downtrend. It's a little bit more of an uptrend here, but then we get another break of structure. This is inverted. Once this fails, it shoots all the way to the bottom there. Here's another example of the exact same thing. This is a second entry short level here. This should hold. It's bouncing off of this for the longer term context. It's coming down. This should hold here. It didn't. It broke. Okay, so where's the imbalance in the market? Low volume node. Looking for the push up. This is a area of big acceleration to the upside. We have a low volume node if we're just using the indicator here. right there. We don't quite get to it, but then we have a break of structure in there. And then also more easily seen here is when we have these big pushes up with no overlap. This is a low volume node from that uptrend push. You see the market comes back up to there. So this is our inversion of that, selling here on a break of structure. Wait for some level of accumulation of value. Right there, we've inverted it, sell here, take it to the bottom. Easy peasy. Oh, and look what happened. Once we get back up to this area, right here, it's broken. And so we need to trade in the direction of the 15-second trend, the short-term time frame. Sometimes I've been trading 1 second, 15 seconds a little bit more manageable. What's my point? When we've broken above this, especially this one, now the market's going up. So you just trade this uptrend. This is inverted. This is now condition 2 on this. It's failing. And so how do we operate in condition 2? Market pushed up, buy value. There's an entry. I took that entry. It pushed above this. Not only is that a value area here, but it's also the inversion of that green box right there. And had you bought this and taken it to the top, it's 100 points, maybe more. So I'm gonna wrap this up. I think I've been going for 20 minutes here. There's more. As I say, I'm gonna wrap it up. I kind of want to babble some more. What was the inversion here? We have a reclaim of value of this. Wasn't it? Okay, I'm gonna wrap it up because I wasn't actually thinking about that. If I had a video editor, I'd cut that. Thanks for watching. I hope this was helpful. If you have any interest in futures trading at all, this is good quality information, basically expert level stuff. I tried to talk a little bit more about the basic concepts. If you don't have a background in futures trading, maybe you're looking to get into this, understanding the psychology, what we're actually doing, and then understanding the technical stuff is required for you to put it all together. Very dense information. I really have nothing else to say. Wrapping it up, understand when things have worked, when things have failed, identify major resistance via the setup I just described with the 3-minute inversions of second entries, and then identify the low volume nodes there, and then wait for a short-term break of structure, and you have a literally viable trading framework right there. I'm gonna keep doing this. I'm gonna keep making these videos. Hopefully you keep watching them, and hopefully you keep getting something from them. I may eventually pull all of the videos because I get a little apprehensive about giving away the information for free that I've worked 6 years to accumulate. But if you've seen this, hopefully you like it. Like, subscribe, comment. Have a great day.